Vice Mayor Filseth? Councilmember Koo? Chair Scharf? Councilmember Tanaka? 4 present.
So I think, is there a time limit, 3 minutes, 5 minutes? Okay,
So normally we do 3 minutes, but I'm not going to be overly.
okay. So I think most of you know for the last 15 years I've been doing this presentation to the city staff and the invited peninsula staff on the economy that underlies what you're doing tonight. And I wanted to cover a couple of points that didn't get into the staff report. I would be cautious about the economy in the short term and the long term. Everybody I deal with, I don't do short-term forecasts, but UCLA and the Federal Reserve and Department of Finance that had a conference is looking for a pretty slow 2020 and 2021 and maybe the end of 2019. So not the current budget year. We'll do better than other areas, but if the national growth is 2%, 1.5%, people are talking about 1% in 2020-21. We're going to feel that here, and I just like you to factor that in. Maybe not so much tonight, but when we get to the 2019-2020 budget, that is going to be in the eye of a beginning slowdown. Longer term, no one that's really reputable is talking about growth more than 2%, and that's a heavy target. You have the retirements, you have potentially really restrictive immigration policies, so the labor force is going to start growing at 0.5% a year, almost every place, and that will restrain everybody's options going forward. We'll still do better. We have Stanford. The last point is when I looked at the county property tax breakdown, how they got the property tax. Kylie couldn't give it to me for our city. But the 2% annual adjustment is just that, it's 2%. So when we're getting 6%, 7%, 8%, we're getting that mostly on turnover, both residential and commercial, and a little bit on new construction, and that varies. But 2/3 to 3/4 of the property tax gain doesn't come from the annual inflation. They come from primarily the housing market as well as your documentary transfer tax. So I would be cautious again about, I'd be really cautious about price appreciation. We're beginning to see lowering rates of growth in prices around the area, additional supply, higher interest rates. I'd be careful when you look at those later on about both projecting the current level of turnover. I'm not an expert on that, but that is a big deal in the fiscal forecast, and I'd be careful about that and really careful about the price increases you think are going to come. They aren't going to be like what we've had. So I guess it's a message of caution about the economic underpinnings of your second item tonight.
Thank you. All right. Staff have a presentation on the first item.
Good evening, Chair. Yes, we do. I am Kylie, the interim Chief Financial Officer, and our first item tonight is follow-up from our initial discussions earlier this year about a $4 million referral in the general fund that the council made during the 2019 budget process. As a reminder, the council had directed staff to cut about $4 million in the general fund as part of FY19, with the implications to be identified after the budget adoption process. The council and finance committee over the course of the past few months further refined this direction, which is before you, and it's that it is $4 million that are not detrimental to the organization or our capital infrastructure plan. And including what it would look like if the staff were to recommend usage of the budget stabilization reserve to solve a portion of this. So tonight we'll be going through that. Getting right into it, before you is staff's proposed changes to meet that $4 million goal. We can spend a little bit of time on this slide. To orient ourselves, the recommended changes are on the far left. The actual dollar values in thousands are right there in the middle column, and then whether or not it is a recommended ongoing change or a one-time change is included to the far right. The details of these changes are in attachment A. I can go through some of the details at a high level verbally. So, additional tax revenue. There are about $2 million, maybe a little bit more, maybe additional tax revenues that are anticipated to be collected during the 2019 fiscal year that were not previously included in the FY19 estimates. Staff's not necessarily ready to make these ongoing adjustments, as some of them are for typically one-time revenue resources, including excess ERAF funds. It's a property tax assessment. And this year in 2019, it's actually estimated to double from prior year levels. So without further communication with the staff, with county, staff is not recommended to recommend that as an ongoing increase. However, it is an additional revenue that wasn't anticipated as part of the 2019 budget development. Other tax revenues that are higher than estimated include sales tax as well as documentary transfer tax. Under the additional expense and contingent account savings or reductions, about $1.4 million in additional expense savings is anticipated this year. Now, that number is not to be taken lightly. It's primarily the result of vacancy savings throughout the organization. We have a higher than normal amount of vacancies throughout this organization, particularly at some pretty high levels. I can use myself and administrative services as an example. With the current chief financial officer position vacant, a bunch of us are playing a little bit of double duty. So this $1.4 million is primarily found in actually the Planning and Community Environment Department. Remember, that does include transportation at this point in time. The additional savings is also in Administrative Services Department, which is about $300,000 of that $1.4 million. And then the rest of it is smattered throughout other offices such as Human Resources, the Library Department, Public Works, and then the last piece is a reduction in contingent accounts. So within our contingent accounts, what those are every year as part of the budget process, a handful of contingent accounts are approved. One of them includes funding for innovation projects, another one is for HR, and another one is for HISRAP. And so these are typically accounts that are drawn on an annual basis as necessary for unplanned expenses or needs. 6 months through the year, staff's not anticipating need of these resources this year, and so we're recommending on a one-time basis that we reduce those 3 contingent accounts. The Cubberley Operations and Maintenance Funding Shift. What this is a reallocation of staffing positions that are charged to the general fund in the Community Services Department and shifting that charge to the Cubberley funds. So the city has a separate fund for Cubberley infrastructure and operations, and so this would be aligning the duties of the staff with the funding resources. It's also recommended that we eliminate one staff position in the city auditor's office. So this would be one full-time position. It is currently vacant. This would actually true up the auditor's office in alignment with actually what a number of other departments took in reductions over the course of the FY19 budget process. However, it wasn't vacant at the time, and so this kind of brings them in alignment with the rest of the organization. And then the last one is heeding the advice of prior conversations associated with this. It would be to reduce the council contingent funds. So similar to that HISRAP contingent account, similar to the innovation and HR contingent accounts, council has their own account. On an annual basis, it's $225,000. Year to date, there's about $30,000 that has been spent. Council had a discussion recently about donating an additional $25,000 associated with the fires up in the north. And so if we were to reduce $100,000, there would be roughly $75,000 left in this account for the remainder of this year. So a lot of numbers floating through. But what does this action do? Oops, wrong computer. So we kind of wanted to highlight what those reductions or those additional funds are doing, kind of from a more high level rather than technical perspective. What this results in is this accomplishes council's direction to transfer or to invest an additional $4 million in general fund contribution to our pension trust fund, the 115 trust. And so if we were to do this, then we would have principal contributions to this trust of about $11.6 million in all funds by the conclusion of this fiscal year. We would actually be starting in 2019 the implementation of the policy direction that the council previously gave staff, or most recently in October, to start to assume 6.2% discount rate for normal pension cost calculations. We refer to this as that pay-go cost, and so what this would ensure is that we are we're keeping up, rather, with our pension obligations and not letting further additional liabilities accrue. This doesn't have any detrimental reductions to the organization or the 5-year CIP, although I'm certain many departments will tell you the pain they feel from the vacancies and the reduced capacity that they are currently experiencing. There is $560,000 worth of ongoing changes in general fund expenses that are recommended in that $4 million. And staff does not recommend use of the BSR. So the BSR would remain above the council-approved target of 18.5%. It's hovering around that 20% range. Again, wrong computer. So with that, staff recommends a laundry list of motions, but those are really the technical transactions to execute that $4 million transaction. It would adjust all of those departments' budgets. It would adjust the revenue estimates and complete that transfer of funds from the city's bank account to our trust fund. And then the rest are adjustments to the table of organization associated with those position changes. And so with that, concludes the presentation, and if council has any questions, or the committee has any questions?
All right, any questions? We don't have any more public speakers, right? No, sir. All right. Any questions? Councilmember Fu?
I just want to clarify. The auditor's office, that one position, how long was that empty for?
It's recently vacant. So it's within the last 4 months that it's been vacant.
And so basically, the auditor has, so without that person in there, they can keep up with their work?
So a reduction in audit capacity will result. So the auditor's office has a goal for their each individual audit staff of 2 audits per year. And so this would generally reduce the capacity of that office on an annual basis.
Okay. So the reduction of the 1.4 building service person lead, as well as the buildings, the other one, are those all city services to the general public?
They are,
So-
but they're actually not elimination of positions. So if you look at recommendation number 3, we're actually adding them back, but it's a technical transaction that we need to do because we have guidance for our charter and our muni code for the table of organization.
So you're
So all we're doing is fund shifting them,
balance.
correct. So So we're moving them from one fund to another fund.
If there's a reduction of service to the general public, then I just kind of want to know about that, but thank you.
Understood, there is none in this instance.
Okay.
All right. A little late, Nielsen, but we'll let you go. You want to go up and speak?
I want to make a couple of comments on behalf of a number of residents that are concerned about the traffic parking deal. I'm not sure this is the best forum to answer specific questions. It may be best that we get with the finance staff and try to understand how some of these expenses are being laid out over time. But let me tell you a couple of questions we have. We've certainly noticed that there's a traffic transportation section. We've lost Josh and we've lost a guy named Philip. And we're just curious about how those replacements are going to be phased in, or if they're going to be phased in. It raises our concerns about there's no detrimental cuts because we see those two key people very important. The other broader question that is being raised is that there's a lot of attention being paid on the grade crossings. That hopefully will rise and fall. And how does that fit into the expense loading that you're being talking about over the next probably 2 years? So I don't necessarily expect you to answer that per se, but we'd like to find a way to have a dialogue with staff on how that's actually being penciled into the budgets.
I don't know if staff wants to say.
Be happy to respond. Ed Shikata, Assistant City Manager. On the first point related to the transportation staff, this proposed action would have no effect on our recruitment and refilling of those positions. Those are underway, although a part of a reevaluation of the duties that would be under the Chief Transportation Official. So again, no impact on this proposed action would have no impact on refilling those positions. On the grade separations, that will be a part of the proposed budget. It's, as Council knows, it's an ongoing project. And so based upon the alternatives analysis that's already underway, we'll be making recommendations for the next phase of those projects.
So in the motion, where is attachment A when we say it? It's on, I just want everyone to be able to look at that because,
Sure, so in the CMR,
yep,
it is
page,
packet page 6. Yes, I'm sorry, of the item 1, it's CMR 9817. It's packet page 6.
Okay.
So, Chair, you're in the,
Oh, I'm in the long range.
correct.
Yeah, it's the one I can't find it.
Yes,
Okay, I got it.
there you go.
Okay, got it. So this is what we're, okay, perfect.
Correct. The chart on the slide and the chart in the memo were just summaries, but attachment A are actually the technical budget actions that staff are recommending.
All right. So I'll move the staff recommendation. All right, I'll just basically speak to it. I think, I'm really pleased that you guys came forward with this. And I actually think it's somewhat historic and puts us at the forefront of really dealing with our pension liability. I mean, what we're really doing here is we're saying 6.2% is the correct valuation, and we need to account for that and not dig the hole any deeper. And so by taking these actions, that's what I think we're doing. We're basically going to start putting the money aside, the money that would be the difference between what we are spending and what we should be spending. So I think that's really important.
There's been sort of an action that's been building to this point for quite a while now. I think it's important that so far of the $4 million, you know, a little under $600,000 is structural, which I think is fine, okay, for this year. And I think the important point, it's somewhat technical, but the important point is not to cut, but to save, right? And so to the extent that we're actually saving $4 million in the Section 115, that's really the objective, right? And the challenge is to be able to do that on an ongoing basis, which is the focus on structural, okay? But this year, given we have $2 million more in tax receipts than we thought we would. It's a perfectly appropriate use of this to do that. So I think this is a good plan.
All right. Sure.
On the HISRAP contingent account, usually how much is in it and how often is it drawn on?
Sure. At this time, actually, his rep has two reserve or contingent accounts. One that was recently established, maybe within the last 2 fiscal years, and this one. The one that was established most recently, that this action does not adjust for, is for urgent needs. And this contingent account was established for off-cycle allocations. So remember, his rep is a 2-year cycle. Since it was established, it has not been drawn on.
How much is it?
50,000.
This is the one.
Yep, this one is 50,000, and since it was established, it has not been drawn on. And so staff carry it forward every year, just in case it's needed, but it's not anticipated right now that both of those reserves would be necessary this year.
Thank you.
Councilmember Tanaka.
Yeah, thank you for your work on this. Appreciate it. So a few questions. On packet page 8, I noticed that the BSR is on there, and I guess it doesn't look. I was just kind of curious why it's even on here, because it looks like from your chart there's nothing about the BSR.
Right, and so what that is again, it gets back to that technical transaction. When when council adopted the 19 budget, and we took that $4 million out of the expense side, we accounted for it from an accounting perspective in the BSR. So what we're doing is we're actually taking it out of the BSR and accounting for it in the department's budgets, so you can see all the negatives in the departments. And then what we're doing is we're taking it and transferring it to the trust fund. So we're not actually, it's a bunch of ins and outs, basically, as we're truing up the plugs that we made in the adopted budget.
Okay.
There's no net change to the BSR.
Okay, that's what I thought, but it was kind of like, I was trying to figure out why you guys
That's
didn't do that.
we left it in the attachments, because it's kind
Okay.
of the technical appropriation ordinance transactions
No, I
that needed
understand.
to occur.
That's fine. And then, can you remind me, what is our rate of return for our section 115?
So I want to say it's the 10-year rate of return is anticipated to be over 6%.
Okay.
Most recently, given where the markets are, it has not been that profitable.
Market went back up.
It did, so I don't have the recent reports, I will admit. But the last time I checked on it a couple months ago, we were somewhere in the 3 to 4% range.
Okay. And what is the pension rate right now in terms of rate of return?
In CalPERS?
Yeah, CalPERS.
So CalPERS, they don't issue it that frequently, what their rate of return is, but on an annual basis. In 2000 and, what year am I in? In 2017, the rate of return was about 8%.
8%, okay.
And so something to realize, just as another anecdote on that is CalPERS is in a more aggressive kind of tier of investments. We have choices on our 115 of what tier we want our investments to be in. So we're actually in a moderately conservative tier. Should the council choose to be more aggressive with it, we could move the portfolio to be more aggressive from an investment perspective. But since we are still developing kind of how and when we would want to draw on those funds, we didn't necessarily want it to fluctuate as quickly.
Okay. So I guess the advantage of the 115 is that it's our money versus this phantom money that goes to CalPERS, which we may or may not see, right?
Sure.
So I think that makes sense, but there's a 2% delta in our investment return, so.
So if the finance committee wanted to.
There may not be a 2% delta.
I know.
The expected return is 6%. So if the expected return for CalPERS is 6.2%, right, then they may be at 8% this year, but that's not indicative of sort of long-term expected returns.
Well, I guess at least the historical number she just quoted was 6 versus 8. I understand that this is.
I'm sorry, so that's something that I should restate. So you asked me
Okay.
what the most recent CalPERS returns were, so I gave you the annual.
Okay.
In terms of what the trust is supposed to earn, that 6.6% average is over a 10-year period.
Okay.
So if you
we're
wanted
not
to
apples and apples. Yeah, okay. Well, anyways, I guess my point is, I think it makes sense to be in the 115, but I also think that we should try to strive to get at least the same kind of rate of return, if not more. And I'm not sure if we are or not.
I mean, they're investments. So like I said, we could bring forward an analysis of the different tiers, and we can choose to be in a more aggressive tier.
Yeah, well, I mean, that's, especially as this gets bigger and bigger, it starts mattering more, so.
Of course.
You know, I think Councilmember Tanaka's right. I think that would be a worthwhile thing for the Finance Committee to look at some point. I'm not saying necessarily this year, but I do think the ability to look at the different tiers and for you guys to analyze why we're in this tier, and that tends to be on how long you intend to keep the money there, right?
Correct.
The more aggressive you are, the longer your horizon needs to be.
Correct.
I think that makes sense. That said, I think, I mean, and I think it makes sense to look at it, you know, as we get further into this process. I think if you make the assumption that we're going to have similar risk levels to CalPERS investments, then it seems likely that we'll have similar returns to CalPERS, you know, assuming sort of, and then we may make choices to say, okay, we're going to take more or less risk than CalPERS, but it seems likely that we don't want to get into a situation where we think we're trying to do some kind of arbitrage between our returns and CalPERS.
No,
returns.
my point more is just, I think we should try to match the risk reward that CalPERS is doing.
I think
Right?
that's right.
So that's what I'm trying to say, and if what I've just.
That's the conservative assumption, yeah.
So, but if, what I'm hearing is that our portfolio is more conservative and theirs is a little bit more aggressive, so maybe we need to tune it just a bit. So I'm not trying to say that we want to like go, you know, Las Vegas on this, but,
But also, given, you might want to average into that risk, given who knows, we could like suddenly become really aggressive and the market could fall off a cliff because we time it wrong. So if you average into it slower, that might be the right way to go.
yeah, I mean, I mean, my main point is, and also, I guess we also know, it probably may CalPERS this as well, but we also know when we're going to need the money, right? When the payouts are going to have to happen. So we could also structure the portfolio to pay out, kind of ladder the portfolio, right? So that it pays off, you know, like the ones that have to pay off sooner, more conservative, the ones that pay off later, right? So,
Actually, from this perspective, we do have control from a policy on, you know, the committee and council have a control on when we choose to draw from it. The constraint we have is that it doesn't go anywhere but to CalPERS. Obviously, that's why it's irrevocable.
Sure.
In terms of laddering the portfolio, that's something that we would look at in terms of our own cash flow, but it is the responsibility of the third-party agency to deal with that from a trust fund perspective. We are authorizing and enabling a company, basically, to manage our trust for us and do the investments for us. So we don't necessarily get that granular. We're purchasing a service from them. Does that make sense?
well, hopefully, I mean, laddering's pretty standard, so hopefully they're laddering,
I
right?
understand that, but what I'm saying is we're not looking at the portfolio, each individual asset that we've purchased in the market
understand.
and when they're coming due.
Sure.
It is actually, I think, a pretty interesting discussion and outlook for the long term. I mean, right now the numbers are pretty small, but you can imagine a future in which there's significantly more money in the 115, right? And at that point, essentially, we'll have taken over, you know, a non-negligible amount of our pension investments, right? Ourselves as opposed to CalPERS, and we'll be sort of, at some level, we'll be running our own pension scheme as opposed to having CalPERS do it. And then I think you're right, which is we're going to start having to look at all these issues that you do when you run a pension fund, which is what kind of investments you put it in and so forth. I mean, I think the end point is you're absolutely right.
Okay. So I don't know, we have to make this part of the motion or what? Or just staff bring it back to us? How does it work?
So, if I can make a recommendation, staff actually owes this committee a pension policy. And I think the frequent review of what tier of investment risk that the city continues to choose as part of the 115 trust is an integral component of that policy that staff needs to bring back.
Okay.
All the things that pension funds do. Right?
We're now a pension board.
That's right.
We're not.
Not yet, right?
So I was reading that Mountain View City ran like $100 million surplus or something like that. And, I contrast that to us. I think we're dipping like $1 million or so into our BSR. Not a lot, but it's something. It's a booming economy still. I just was thinking of the contrast between the two cities, and we're like neighbors. And I appreciate what you're trying to do. Maybe if you could go to slide 3. I definitely appreciate what you're trying to do here. I mean, we have about 600,000 of structural, actually a little bit less than 600, but something close to that. But I was actually really hoping to see $4 million of structural changes, right? And especially in this kind of economy, you would hope that we could figure that out. But most of this looks like it's one time only, right? And I read the appendix. Some of it says that some of it might become, we might get lucky, right? So I realize that maybe some of the tax revenue might be reoccurring. Hopefully it is. But our economists just warned us that there's storm clouds on the horizon, and there might be rainy days ahead, right? So I guess, did staff actually do the work to see what it would take to actually do a structural $4 million cut? Because I think that's what we're trying to do. We're trying to do this. We're trying to make it so that we just don't do it today, but we do it. Do it this year, but we do it every year. And so, what did it look like when you try to do a structural $4 million cut?
Sure. I can tackle this from a technical perspective. And just one point of clarification: the number that you're quoting for Mountain View is actually a CAFR number, and a CAFR number is not apples to apples to budgetary numbers.
Okay.
If you wanted to look at apples to apples, I'm not 100% sure.
Okay. Well, that's not the main question. So the main question is more about what would it look like
Sure.
if we were trying to do a structural $4 million versus a $555,000 structural.
So they're supposed to come back to us with next year when you're here with after doing a deep dive on the structural stuff. We voted on that issue.
I was curious if they did that. I was curious if staff looked at that already.
So that's phase 2 of this whole endeavor. That's the direction that council had given us. So council had given us the direction that in phase 1, which is before the committee tonight, it could be one time or ongoing, and phase 2 is the ongoing component of it. And so phase 2 is where the expectation is that staff comes back to cure the entire gap on a structural basis.
Yeah, but what I assume is that as you came up with this 555, about a quarter of this which was structural, you must have done some analysis and you saw that that you could get at least 555, right? But did you also do the exercise of, well, what if we did more? What would it look like, and what would be impacted?
Sure. I mean, staff on an annual basis is always looking at how to structurally balance the budget as part of every budget process, including something like this. But there were specific directions as part of this referral that there isn't anything that is service impacting, that there's nothing that is impacting on a negative basis the CIP, and nothing that's impacting the organization as a whole. And so with those kind of parameters, that's why staff brought forward what's before the committee tonight.
So one thing you mentioned, I just want to see if I understood it. I think you mentioned that this $4 million will cover the unfunded pension deficit that we're accruing every year, right?
So what this $4 million does is it is basically the difference, and it's a rough calculation, but it is the difference between the normal cost, assuming a 7.25 discount rate, which is what CalPERS currently has, and a 6.2% discount rate. And so depending on one's opinion of what CalPERS's annual investment earnings will be over a long period of time, this makes that more conservative. And so what it says is that we aren't increasing our liability by assuming an overly optimistic return on investment.
No, I understand that, but I thought the figure was $8 million, and that we're doing half of it, right?
Right.
And that just covers half of that.
And so that $8 million figure was if you calculated both the normal cost component of pension as well as the unfunded liability. So remember, the city has two components of pensions, normal cost, which is
Okay.
that pay-go.
So when you were saying that this would balance, you were referring to just the first part, not both of them together?
Correct,
Okay, that's what I just wanted to clarify.
yes.
Okay, that's all I had.
All right,
Thank you.
great. All in favor of the motion? That passes unanimously. Thanks, guys. Thank you.
Thank you.
Works very much.
All right.
Okay, on to the next item. Do we have any public speakers on the next item? All right. Going once, going twice.
Okay.
All right,
So moving right along, the next item we have is our long-range financial forecast, which is actually a component of the next step of our previous conversation. And so Steve will be presenting, and I believe Christine's going to help out.
That is correct. Good evening, Chair, Vice Mayor, members of the Finance Committee. Steve Guagliardo with the Office of Management and Budget, here to talk to you tonight, about the FY 2020 to FY 2029 long-range financial forecast. So at a very high level, this is the opening salvo of the development of the FY 2020 budget. It's meant to give us context, and that's really important to keep in mind as we go through all of this. It gives us a short-term outlook as well as a long-term financial outlook. One of the very critical parts of all of this is, like any forecast, it is meant to model and develop macro level trends. It is not meant to get down into the details and the iotas of every little thing that's happening across the organization, especially as you move through the years in the forecast. For the next few years, the forecast is pretty good and it has a number of the variables accurately modeled. After that is when you start to transition to those larger scale things and the confidence level decreases a little bit. It gives us context for the development of both the operating and the capital budget and lets us see how the general fund is doing in terms of our revenues and expenses. It presumes that everything stays as it is right now. It does not model service delivery changes. It does not look at things like if you were to reduce public safety positions. It does not look at things like if you were to reduce library hours. It does not contemplate any of those policy level discussions about service delivery. It models if we were doing what we do right now, how much would it cost us in the next year? If revenues continue on their current trends, what would that look like in context of the revenues? One of the really important things to keep in mind as we look at this forecast that is a material change from the past practice of long-range financial forecasts is in the past we've used the CalPERS actuarial determined contribution. Per City Council direction, we have changed the base case for long-range financial forecast. For this fiscal year 2020 to FY 2029 long-range financial forecast, we are using the normal cost calculated at that 6.2% discount rate. So a full percentage point and a little bit more lower than what CalPERS has listed as their actuarial determined contribution. We'll talk about that a little bit more as we go through the full presentation, but one of the things to keep in mind is that when we developed the FY 2019 budget, we did reduce expenses in the general fund by about $2.3 million. So as you look at the structural impacts and what you see in the forecast, keep in mind that if we hadn't done those structural reductions in FY19, the gaps would be even wider. The problems would be broader, but that's not where we are. So with that, we'll get right into the graphs. This graph shows the general fund net operating margin. This is a year-by-year look at how the general fund's revenues match up with their expenses. In a year where revenues exceed expenses, it's above the line. In years where revenues are less than expenses, it's below the line. So right off the bat, you're seeing a slight gap of about $2.8 million in FY 2020. Again, this includes the calculation of the normal cost at that 6.2% discount rate. And we'll talk about that in one of the alternatives as we get there. But we're looking at about a $2.8 million gap in FY 2020, about a $4.5 million gap in 2021, and then it starts to get better with about $3.2 million in FY 2022 and $1.7 million gap in 2023. After that, and again, it's a little bit further along in the forecast, the confidence level decreases a little bit as you get out that far. You start to switch and you're in surpluses. But this graph is only half the story. This is looking at it on a year-by-year basis. What we have an obligation to do as a city is balance the budget on an annual basis. And we strive to do that structurally to the extent practicable. So this red line superimposed on the blue line shows what happens if you structurally solve the budget in 1 year. If there's a gap, it's presuming that you are solving that gap with a structural fix. And if there's a surplus, it's assuming that you are spending that surplus structurally on whatever you want to spend it on. So with that, we actually transition to the positive a little bit sooner. We would solve the $2.8 million gap in FY 2020, which is what everyone around this table is expecting to have happen. And then that would shrink the gap in FY 2021 by that same $2.8 million because you've structurally solved it. Then in FY 2022, you'd be looking at a surplus.
Well, why does the blue line go up so sharply and the red line doesn't?
Yep, and that's because it's presuming that in any given year where you had a surplus in that blue line, it's presuming that you are committing that spend on a structural basis. It could be for infrastructure, it could be for service delivery enhancements. It's just presuming that that money is going to be spent. It could be for pension obligations, what have you.
The delta between those 2 points is that much.
Yep, exactly. And we'll see that illustrated. I'll just flip ahead to the chart version of this that has the actual figures on it, and it shows that exact same thing. So the delta between those two data points is what you see on that bottom line of the net operating margin. So this is the chart version of that same graph. For those of you who might be more numbers oriented, a little less visually oriented, this is the same data. It's showing what we adopted in FY 2019. The total expenses includes that $4 million reduction that City Council recommended. The 3 years that are included in that box are where we're pretty confident in the model. That's where we have the details. That's where we've got sufficient data to be using this as a fairly constructive policy guide to inform the budget process. Once you get beyond that, you can see the shading starts to change a little bit more to the yellow, and that's to reflect that the further you go out in the forecast, the less confident we get in the numbers beyond the macro trends that we're modeling. So one of the things that kind of jumps off the page on this is the expense increase from 210.7 million to 229.9 million, which is a percent increase of 9.1. So we wanted to make sure we took time to walk through with you, the Finance Committee, what is responsible for that increase. And that's contained here on slide 6. So the adopted budget number included a number of unique circumstances, one of which was the inclusion of that $4.0 million expense reduction per City Council direction. Another was one-time FY 2019 balancing solutions. And then again, that material change we're doing, that difference in how we treat the normal cost, whether we're using CalPERS actuarial determined contribution rates or we're using this lower discount rate at 6.2%, is responsible for another portion of that. Additionally, the city has agreed to labor agreements with its public safety units. Those carry us through FY 2021 into FY 2022, and the marginal costs for FY 2020 are included in the 20 forecast. And then beyond that, you've got the other general inflation. So even though your overall increase in expenses is 9.1%, most of that is attributed to timing stuff associated with when labor contracts were agreed to, when council gave direction about the 6.2% discount rate, and that $4 million reduction.
Can I ask a question? So what is the difference between line 1 and line 3 there?
Yep, so line 1 was the one-time reduction in expenses in the 19 budget. So if council carries forward the motion that Finance Committee just passed, right, then a portion of that would be restored as an expense. But it's just one of the things keeping the 19 budget artificially low in the adopted number because we had to reflect the direction we had been given at the time. The 6.2% discount rate number you're seeing there is then the 2020 portion.
So it's almost like you're doubling that growth, just this instance, right? Because we're restoring that one time from the 19 budget to get you back to the 214, which was the $214 million general fund expense budget. And then you're also, in that same year that you're restoring that, you're doing the 6.2, so you're adding an additional 4 million, so that's 8.
Why are we restoring 4 million? Shouldn't we be restoring 3.5 million?
Right, and so
We have 500,000 in structural changes, so
Yep.
shouldn't we be restoring 3.5 million?
and
So one thing to just clarify, that 560,000 of structural changes is not contemplated in this
forecast.
forecast at all, because we did not have council approval. Yes.
So if we go to, okay.
Yep, and that 4 million was only a one-time expense reduction. It wasn't from a council approval perspective an ongoing thing. So we are very literal when we do a long-range financial forecast.
Okay, so we're already 500,000 to the good if council
Right.
goes with this.
Exactly.
There you go.
Let's party in Napa.
One other question is,
It's been 250.
so does this also contemplate the $4 million that we're trying to save for next fiscal year as well?
So the The $4 million that we're trying to save.
The additional 4 million.
So the council direction is to budget the normal cost at the 6.2% discount rate, and that is included in the long-range financial forecast.
Okay, so it includes the total $8 million that we were trying to, so that we're basically not running a pension deficit.
Yep, and to Kylie's point, council direction was to budget the normal cost at 6.2%, and there's two elements to the pension obligations. There's the normal cost, the pay-as-you-go, and the unfunded accrued liability. Council direction was to budget the normal cost at 6.2%, and that's what is included in this long-range financial forecast.
Okay, so the other part's missing then, in this at least.
There is not, yeah, that is accurate.
Okay.
Bear in mind that there's sort of two separate problems. One is to stop digging the hole deeper, and the other is to fill in the existing hole. I think you guys called it the catch-up payment or something like that. So by doing the 4 million, not 8 million, but just the 4, we solved the first one. So we're not digging it any deeper, and that's pretty significant. And then the rest of it has to do with how fast we amortization. To put it another way, if you solve the normal cost problem, then you're not increasing the future value of the liability. And I think that's pretty important.
May I ask a question?
Which is ironic because the present value of the liability still increases, but the future value doesn't.
Okay, yeah, I'm glad for that clarification. Apologize for being late. I was tied up in another meeting. Because the unfunded liability, though, is still being calculated at the sort of PERS rate, the present value does, in our view, increase on the unfunded liability. Okay, great.
The future value does.
But the future value does not.
All right.
So as with any forecast, there are a number of factors that are not yet quantifiable and are therefore not included in the forecast. Those are shown here on slide 7, I believe. One of those is the increased costs associated with capital projects that we don't yet have refined estimates for. As we go forward, we go out to bid. They continually come in higher than expected. That has to do a lot with the regional economic trends that we're seeing and how much we're getting charged for each of those projects. You've got things like the JMZ Phase 2 that are coming up in the very short term, in those 3 years, for example, that we are pretty confident in, but we still don't know exactly how much that's going to be, so even that is not included in those 3 years. You have future labor agreements. So we are modeling the expenses consistent with MOAs for the safety units, but SEIU's labor agreement ends December 31st of this year. Any increases beyond what we do as practice, which we'll talk about on the expense side of this, are not yet modeled in here. Measure E passed in this election, the additional TOT increase. Additional revenues associated with that are not modeled in this long-range financial forecast. At the time it was developed, we didn't have the results. We'll revisit that as we go through the budget process. There's master plans associated with both parks and with the Cubberley Center. What happens as a result of those master plans is not yet quantifiable from an expense perspective and is therefore not contemplated in the forecast. Grade separation, which we're all aware of is going to be a very significant investment on the community's behalf, not yet modeled in the forecast. Additionally, we've talked about capturing the normal costs associated with pension. To Councilmember Tanaka's question, the UAL portion of that is not included in the forecast. Finally, you've got city-owned assets operated by nonprofit organizations and what may happen there, things like Avenidas, et cetera. And then finally, of course, there's what our local economist, who's still in the audience, was talking about earlier, which is, the potential for a recession. And just to be clear, none of these things are modeled in the base case. And we'll talk about how the alternative scenario number 2 does attempt to model the impacts of a potential recession. But in the graphs you've seen so far and the chart you saw earlier, none of these things are contemplated. With that, we're going to get into a little bit more detail about the revenues that are included, and I'll turn it over to Christine from the Treasury Office.
Hi, Christine Paras, Assistant Director of Administrative Services. We're experiencing really strong growth at the local level and at the national level. California continues to outpace the national level housing and employment rate is really good in the area. We're actually at kind of full employment for California, which is a good thing. A couple concerns that we looked at when developing our assumptions for revenue were that when a recession is expected to hit, what the demands are in the local real estate market and how spending is doing for the average consumer. We're seeing really good tax revenue growth in the next year. We're increasing by 7.2% compared to the 2019 budget. Sales tax in the medium term is experiencing strong growth, and that's due to consumer spending. There's a lot of different ways consumers can now spend. There's different retail formats that people can take advantage of, and we're actually seeing the trends in our sales tax consultant report where instead of sales tax going to traditional segments such as like retail, apparel, and all that, it's being allocated in our county pool. So we're projecting for 2019, sales tax revenue is going to increase by 1.2 million. And in 2020, it's expected to increase by another 1.8 million. Some of the segments that are driving this are electronic equipment, restaurants, furnitures and appliances, and auto leases. And those are experiencing the most robust growth per our latest quarterly data from our sales tax consultant. As far as property tax, that's always been our most resilient, strongest tax revenue source. It's actually our largest. In the past 3 years, it has grown over 17%, which is pretty phenomenal considering everything. It went from 36.6 million in 2016 to 42.8 million in the latest projection for 2019. And I think I heard Steve Levy briefly explain a lot about how property tax really does depend on your turnover. And that can be a really difficult thing to project. And turnover for commercial properties is also a driver, and it's difficult to project when those types of transactions happen. So in our documentary transfer tax and in our property tax projections, we kind of looked at the base of what that is and projected based on that. One thing to note that is interesting, at least me from watching the real estate market, is although sales volume is lower in recent information and data we have, median sale price is up. So it's kind of like leveling off each other, but sale prices continue to go up. And that's just the nature of property tax and assessed value and all that. We're expected to end 2016 a little shy of $1 million by year end compared to the adopted budget. And in 2020, property tax is expected to increase by an initial $2 million. So that's a really resilient, strong base we have in property tax. For the second bullet, the main bullet, longer term projections, one thing we do look at when developing our projections and kind of a second data point check is the compound annual growth rate, the CAGR. For tax revenues, it's 4.3% over the length of the forecast. And for non-tax revenues, the CAGR is 1.7%, which kind of lines up to CPI.
Great. Thanks, Christine. Well, with that, we'll dive in a little bit more into what we're doing on the expense side. So some detail here on how we model the expenses and what you're seeing happening there. Starting off with what is the most significant component of the general fund expenses, about 60% salary and benefits. We're a service delivery organization, and we're a service-driven organization, and how those services get delivered are employees. So we build this based on actual employee data. It's consistent with the current MOAs that we have agreed to, so safety is through June 30th, 2021. The annual pension contributions are as required in CalPERS actuarial reports, plus the lower discount rate modeled for normal cost. CalPERS only goes out to FY 2026 in their projections. After that, we do a modeling consistent with CalPERS, and again, we layer on that additional normal cost associated with the lower discount rate. For labor groups that aren't under an MOA or have an MOA expiring in the contract, so SEIU's ends December 31st, for example, we have a 2% general wage increase modeled. One thing that's important to keep in mind as we talk about this is for positions that are stepped and have an annual increase built in. You start out at step 1, then you move into step 2. We capture what step the employee is at, and we move them through those steps in our software to capture that. So that 2% general wage increase is really just over and above that step progression. On the non-salary side, we have adjustments to the FY19 adopted budget. So we remove one-time expenses and revenues, including things like that internal service fund subsidy that we had in FY 2019, including things like the $780,000 grant we have from the FTA. That's a one-time revenue and a one-time expense in FY19. And then we model CPI increases and look at what's happening on various things. So for example, rent, we're seeing pretty robust expense growth there. So that's closer to the 3%. And some of the other things like supplies and materials, we model a more moderate CPI, closer to 2%. We look at the changes in the index from August to August for the development of this. That's based on a timing thing. As we go forward with the development of the actual budget, we'll look at the changes in CPI over the December to December timeframe and see if we need to adjust that at all. The other thing we do in the long-range financial forecast beyond the base case, which we've ran through now and talked about the revenues and the expenses, what's included and what's not included, are run some alternative scenarios. So the base case is at the top, and that's the same bottom line figure you saw from the chart earlier in the presentation. And then there's alternative scenario number 1, which is showing the single year gap in revenues and expenses. So alternative scenario 1 shows what would happen if we use the normal cost calculated at the CalPERS discount rate, which is a phase-in to 7% by FY 2021. As Kylie mentioned earlier tonight, CalPERS is projecting a 7.25% discount rate for FY 2020. So if you look at alternative scenario number 1, you see an actual surplus in FY 2020 of about $1 million. And that, again, reflects the hard work that this organization has done to structurally balance the budget in FY 19. And then if you were to follow and include council's current direction about that lower 6.2% discount rate, that's how you would get to what we see in the base case of the smaller gap of 2.8. The next thing that we model in alternative scenario number 2 is the major tax revenue sensitivity analysis. That's, again, a long-winded way of saying this is the recessionary model. And if you look at this, you see pretty quick, we keep the 6.2% discount rate for normal cost calculation in here, and essentially what we do is model the impact on tax revenues. Tax revenues are a significant component of the general fund revenues, and if you look at what we experienced in previous recessions, you start to see just how significant an impact that could really be. The base case model is what Christine talked about, that steady, resilient growth that we're seeing in each of those. If those parameters change, you could see something closer to alternative scenario number 2. And we'll run through the graphs associated with each of those, and I think those give a slightly different lens to look at it, so we'll talk about that a little bit more when we get to that slide. It's only one away. So this is the normal cost of the CalPERS discount rate. Again, you see that we're in a surplus in 2020. It again presumes that we're structurally going to spend that, so then you run into a much smaller gap in 2021 before getting back up to a surplus in 2022 and then staying kind of in the black for the rest of the forecast. This really shows what CalPERS is telling us we need to do. The base case really shows what council has given policy direction on of presuming that 6.2% discount rate.
Just one thing. This alternative scenario 1, if we were sitting here 12 months ago, this would be our base case, just so that everybody understands. But since council has given us the direction this past October to change that core assumption in our pension costs, we've now flipped. Our base case is now our alternative scenario 1 and vice versa. So this is before you on the slide before you right now is what we would be looking at on a normal kind of basis. But we've changed our
Now we have a
direction.
new normal.
We do have a new normal.
Actually, a question for you. On alternative scenario 2, you said this was a recession scenario. How much of a recession is this?
Right, and so what we did was, and I'll let Christine and Taryn weigh in a little bit as well, but what we did was look at how the general fund's tax revenues were impacted in previous recessions and kind of tried to model that through it all. So if you're asking for like the magnitude of it, I'll defer to the Treasury team to weigh in on exactly how that impact was quantified.
I can't really quantify. I mean, we look at each of the revenues, and each revenues. Oh. Hello. My name is Taryn Narayan, manager of Treasury Debt Investments. what we look at is we model each of the revenues. So, for example, property tax documentary tends to be a 1-year delay. When a recession hits, TOTs, sales tax tend to be almost immediate. So that's why you kind of see the decline increase about 2 years out versus the first year. So we look at each of them, and as Steve said, we look at the past recessions in 2008 and the previous one in the 90s, and we kind of extrapolate based on that as best as we can what the likely scenario is going to be. What the future actual will be, who knows?
I was going, so you used like the Great Recession, the big one we just had, as the model. Like, what happened? Is that what you're saying?
I didn't use the full extent of the Great Recession. I looked at what the Great Recession was. I looked at what what we had in the 2000, and kind of extrapolated kind of a little bit greater than probably the earlier one and less than the Great Recession.
Right, and the big takeaway here, right, is you are in the red for a significant portion of this forecast in alternative scenario number 2. You are running gaps all the way up to near $25 million in the middle of the forecast before recovering as we modeled not only the downturn, but also the recovery from that through the end of the forecast.
And the recovery phase also assumes sort of the yellow bar returns or yellow bar estimates for expense growth and so forth, right?
So that's actually an interesting point for this particular model. So the base case has some factoring of this into it already, just, in the growth and everything. The Treasury team really gets into the weeds of the tax revenues in this forecast, and so the recovery, the revenue side of this is actually kind of modeling, again, building in what we saw last time. And so I would just caveat that a little bit, that there's a little bit different confidence on the revenue side of this one than there might be in the base case. Yeah. So with that, we'll just kind of recap everything we ran through. The forecast is not binding. It is meant to be context. It's meant to give us some information as we go through the policymaking process in the FY 2020 budget and beyond to reflect the financial status we have and the current service levels we have in the general fund. As the Vice Mayor just pointed out, the first few years of the forecast have that higher confidence level than the final years of the forecast, especially in the base case. We as a city are continuing to face competing priorities. Over this horizon, we're going to face several large strategic decisions, and we need to make sure we look at these in their totality to make sure we have a balanced approach.
So if you go back for a second to the back another couple to the base case chart. Yeah, actually, yeah.
This one?
Go back to the other one, other version. Back a couple more. That one. That one. So essentially, particularly in mind of the possibility of alternative number 2 there, the third scenario, right? The one with the big dip, right? It's incumbent on us as council and city. We ought to take steps in 2020 and to manage out that minus 2.8 million, 4.5 million. That's my takeaway from this. Is what you're saying? Is that basically accurate?
Right. I think we strive to structurally balance the budget on an annual basis, and we strive to do that not only for the current year, but make sure we're looking at the near-term horizon and factoring those in as well. And so with that, right, the challenge of competing priorities will require those structural adjustments that we just alluded to. The only way you solve the 2.8 and then the 4-point number is with those structural adjustments.
So just if we do $3.5 million next year, which you're sort of committed to in some ways, you're supposed to do the deep dive and come back with another $3.5 million, roughly. If we do that, the 2020 dip goes away, right?
That's correct.
It's really sort of that.
It goes positive.
Right, no, but it goes positive, because we're at 2 point, I forget the number, 2.8.
Yep.
Right, so if we do that, the whole thing then starts to look a lot, right? Because then we've gotten, for the next year, we have less of a negative as well.
Correct.
Yep.
That's correct.
So what I thought. So it's actually, so if you can accomplish what we sort of set you as the task for next year, it actually looks like it's sort of a rosy future in some ways.
That doesn't assume a recession.
No, it doesn't.
And-
Unless you look at alternative
I
number
think-
2.
I think,
Much better than.
Well, as Councilmember Tanaka
Yes.
has often said, it's got to at least look good during the good times.
Well-
I mean, you don't want it to look bad during the good times.
and I really think that speaks to the choices, decisions, and frankly reductions that this organization has made over the past few years. The $2.3 million reduced in the FY19 budget is nothing to sneeze at. The numbers would be different if those numbers were not reduced on a structural basis. So the fact that we're looking at a 2.8 with that 3.5 to return to is only possible because of the work we've already started on. And so I just want to be clear, this is the continuance of the journey we've already started. This is not the first step in it.
Well, it actually seems to me that it's been I would say, a 9-year process, actually. I mean, since the Great Recession stuck, it really has. I mean, we've been pretty fiscally conservative over those last 9 years because of the Great Recession. And what's really great to see is that it seems that we're continuing that as opposed to going back to what I would call pre-Great Recession, which was much less fiscally conservative, I would say. And I think the challenge is going to be to continue to invest in paying down our pension obligation and not making it worse, and to keeping up with our infrastructure, at the very least, so we don't get behind like we were in 2007, 2006. And if we can do those two things, then I think we've really set ourselves on a good path. So the one other thing I was actually wondering about is, it seems to me that it actually would be a useful exercise, not this year, but to take your forecast of what you did, your long-range financial forecast, and then talk about why it didn't match up the next year. They never match up, so they're not going to match up, and we shouldn't expect them to. I'm not saying they should. But I think it's a useful exercise to understand why it didn't. I mean, especially for council members like myself. Like, I have no idea why it didn't. And I think it would be helpful to know, were the revenues pretty close? They should be pretty close, but if they weren't, why, what happened? What expenses, and, what actually happened. That would be a helpful exercise.
Right. I think one of the things we can incorporate into our existing process, especially with regards to the actual FY 2020 budget, is helping crosswalk. So we presented a long-range financial forecast to you that's based on the information we have available at that time.
Right.
As that information gets more perfect, as it gets refined, all of those change. And so then being able to crosswalk with you and say, this is what it is now, this is what changed, and then that helps do that a little bit in a more real-time basis. And then, if you're trying to see anything beyond what changed from when we presented the forecast to when we're presenting the budget, it's not as useful, but I think that's certainly a step that could be taken to help perform that crosswalk.
I think that crosswalk would be a useful exercise, because
Hey,
people would then understand it, and then this would have a context of why it matters and where we went.
Greg, could I add something down here?
Sure.
So, we actually sort of default to being more worried and negative when we're thinking about the scenarios for the future. I mean, we try to be really pretty reliable, what we think what the revenue streams are, and then we're more often than not interested in identifying problems or pitfalls that will come along. But I think it's helpful to add to what we've done over the past decade, though, too. And that is that, in addition to cutting back our workforce and not growing it it's still lower than it was back in 2007. We didn't just invest in infrastructure. We did, and I see Steve Levy here from the IBRIC, and of course you were on the IBRIC, Greg.
I was.
We made, no, the other
Oh, the
Greg,
other Greg.
yes. We made a comparatively massive investment in infrastructure, in catching up with a lot of deferrals from a generation and providing new infrastructure for the long term. Now, some of what we're doing is going to be financed through debt service, so we're going to be paying that. But I don't think you're going to have the same degree, let's put grade separation aside. And that's a big aside to put aside, I understand. But doing that, we're not going to have the scale of what we did this past decade and having to catch up on infrastructure, to the extent that once we get through a recession, we could maintain some of the same discipline and the same some same degree of discipline and some of the other issues that we have, there should be more flexibility for dealing with some of the pension and or other issues that the city has. Again, grade SEP aside, and that's such a big potential demand.
You know, I want to address the grade step thing, because I actually think we think about it wrong. So, I was actually interested in what Mark Berman said about, I think it was the San Mateo grade step that they did. If you looked at it, they spent $12 million on it, right? And then they cobbled together these other funds. I think there's a lesson there that we tend to assume that we're going to have to pay for it. High-speed rail needs it as much, Caltrain needs it as much as we do. I think it's a mistake to think that we're gonna pay for most of it. I think we're gonna pay for 10, 15%, something like that. Unless we raise our hand and say, yep, we're gonna pay for the whole thing. If we do that, we will pay for the whole thing. Because so I think we should be a little careful about what we want to spend on this.
Yeah, I didn't mean it for we.
God, I hope you're right.
Ourselves to that.
Well, no, I mean, I do think that if we raise our hand and assume we're gonna spend it,
Yeah.
every other community will pay nothing, and we will pay for it.
I just think it's a known issue that we've got to manage, right? And, I mean, the fact is, if we could continue over the last decade and I do not think the infrastructure investments will be necessary new ones to the scale that we have been doing, the ability to carve out additional $4 million long-term for the future pension or other things are clearly within the range of realm of possibility, for us to manage, so.
But I will say, I mean, we run our city differently than other cities. So other cities are poor for the most part and don't have the money to do these things. So they cobble together grants. They're much more aggressive on that kind of stuff because they have no other money. We tend to think we can go it alone, and we do because it's a lot easier. If you pay for it yourself, it's a lot easier. But on grade separation, if we don't think about it carefully, we're not used to cobbling that money together. We'll get in the mindset if we have to pay for it somehow. And, everyone's gonna let us do that if we step up. So I would just caution people to be a little more concerned about, that we don't have to pay for it.
Well, we do need to ensure that we cobble together the commitment that we believe that we are due on the bond funding that the voters approved in Santa Clara County for grade 7.
Yeah, no question.
Definitely. If I could chime in there, we'll definitely want to consistently and loudly express our expectation that other partners will also contribute to the funds, whether it be Santa Clara County, the state, everywhere in between, including private entities that will also benefit both locally as well as along the corridor. The one, to your point, both of your points, that Palo Alto has traditionally been able to go it through a pay-as-you-go model as opposed to debt financing or relying on grants is a large part of our financial strategy. The one area that is a significant upcoming change to that is our water pollution control plan. And the committee will be having some discussion on the debt service obligations associated with that, which are not insignificant. And that said, we will be coming forward with some additional information on that.
Anyone else? So shall we then just, okay, go ahead.
So, given what the city manager said, which, that we should be okay financially, to handle other type of expenses, why not try to also include the unfunded actuarial liabilities for pension and retirees? Why not try to get the extra $4 million? Why not try to get the full $8 million?
So that's something that is at council's discretion, to give staff that policy direction. Staff has thus far in this long range followed the policy direction to date.
Okay. Well, I mean, if we're gonna try to do it, let's try to do it right. Why not try to get this into long-range financial forecast? I mean, I'm asking my colleagues here. I don't know if, it sounds like the city manager, we could probably do it. I don't know why my colleagues would object, but I'd love to hear your opinions about that. So the other thing I wanted to ask about is on packet page 35. So I'm looking at the salaries, right? And the salaries in 2020 are 10.7%, and then in 2029 it goes down to 1.9%. Is is that realistic? I mean, is that really what's going to happen? I mean, so far, we give 5.5% raises a year. I mean, I've never seen a 1.9% raise.
Sure. So I'll respond to that a little bit. So the jump you're seeing from the adopted to the FY 2020 number reflects the agreements we've signed with the safety units. So those significant increases were not included in the FY19 adopted number. So just like you're seeing the double up of the 6.2% because it wasn't included in the adopted, you're seeing that there as well. You're seeing not only the amount that we're paying in 19, which was not included in the adopted figure, but you're seeing the marginal cost associated with 2020. And to the last point you made about the 1.9% increase, we talked a little bit about how stepped positions are modeled in our software. So if you're currently at step 1, by the 5th year of the forecast, you'll be at step 5. That's the top step. So the model presumes that you're still there, and so therefore you're down to about that 2% growth down at the end of the forecast.
Because I see that benefits go from like 9.9% in 2020 to, in 2027, negative 1.5%. Actually, we save money, right?
Yep.
And I'm just trying to do a sanity check. Is that really possible? I mean, it'd be nice if it is. It seems hopeful, right?
So unsurprisingly, the biggest factor for our benefits is pension. So that 9.9% number you're seeing, again, 19 over 20, is that doubling because you're having to capture the 6.2% discount rate's impact on normal cost. What happens as you go out in the forecast is our pension rates actually get better as you go out. CalPERS is changing its discount rate to that lower 7%. That's reflecting their more conservative risk profile. That's reflecting the fact that they're expecting to actually meet that. So you see pension rates actually spike towards the middle of the forecast, and then they start to taper down in both miscellaneous and safety.
Okay.
And so that negative number you're seeing in 2027 is the tapering down of that CalPERS number and our modeling.
And one other point is, just one other point on that is, what CalPERS does is they have an amortization schedule. So every year, any gains or losses in the portfolio is amortized over a certain period of time. And so what's actually happening in the 2026, 2027 timeframe, some of those losses are actually reaching the end of their amortization period. And so you kind of see this peak and slow decline, I guess, I don't want to call it a valley,
Well,
based on CalPERS's current assumptions and the current amortization schedule for each year of the portfolio's performance.
Okay.
Yeah, but, okay, right. I mean, the UAL payment that Greg's talking about, right, and you guys are talking about, fundamentally depends on a couple of things, right? It depends on what the estimate of the unfunded liability is, right? If you believe that CalPERS' real rate of return, true rate of return, is going to be 6.2% or 1% or whatever it is instead of 7, then it's inevitable that CalPERS will continue to lower their discount rate even after the 7%. And maybe they do it in 2021, and maybe they do it in 2025, and maybe they do it in 2035, okay? But it's going to happen, okay? The second thing that happens is, although it's possible we fix this with the normal cost, but as you add more debt onto the UAL, the size of the UAL increases, okay? And CalPERS will continue to adjust the amortization payments based on that. And then the last piece is one of the other variables, and we all assume this is kind of a second order effect, right? Is that to Councilmember Tanaka's point about what you assume for average wage growth rates, okay, which we model at 3.5% or something like that for actuarial purposes, right? If it in fact is larger than that, then that increases the normal cost as well. And so if we're not covering the normal cost, if that's the case, and we don't know, but if that's the case, then those compounded debts are going to be added onto the UAL as well, and that will increase the, so in my opinion, the assumption that the growth rate of the UAL is going to slow materially, that's an assumption that carries some risk. Okay.
I agree with that. So, anyways, it just strikes me the long-range financial forecast, especially for the salary, seems maybe overly optimistic. I wish it was true, but we'll see. And then the other thing I was looking at is the property tax, and I noticed that it's on page 34, that it's showing, kind of like a sustained growth rate of 6%, right? And is that really realistic? Do we really think that? I mean, maybe I could ask the economist in the audience. I mean, is that? I mean, is that really realistic? That will keep. I mean, maybe recently it's been doing that, but is that going to really happen over the next 10 years? I mean, I really wonder if that's realistic.
Terrence.
Tara, again, if you look at a CAGR for the last 10 years, it's about 6.37%, roughly. So just looking at the last several
That's
years.
after the Great Recession, so that's the thing. That's why I worry about it, right? I mean, it's like you're taking from like at a time when the prices in Palo Alto actually fell down, right, which is not very common. And so like right now we are at a peak, right? Most people would think we're at a peak in property prices. I mean, how much higher can it go? We're at like average house price of what, $3-something million, something like that. I mean, how much higher can it go? I mean, it's a pretty big assumption.
I remember people saying that in the 90s. How much higher can it go?
I know, but
600,000.
but it's like.
2007, they were saying.
But I'm saying you're looking. It's one thing to say how much higher can it go after a big recession. It's another thing to say it after when we just had one of the biggest bull runs in our lifetime. So maybe I could ask the economist.
ahead.
Steve, can you answer?
I'll repeat what I said at the beginning.
While Steve goes up there, if I could just sort of add, we're dealing with the revenue yield. So I'm out of my element here, but the fact of the matter is, I mean, one could argue, boy, if we started having a down slope, would there be more sales of property because people see that? And the fact of the matter, if we're selling property that has a low assessment and a tax yield, we're still going to reap significant tax revenues from that. So we just needed to keep that in mind.
Yeah, Greg, I'm just repeating what I said at the beginning. I live in a world where everybody is forecasting lower rates of home appreciation. You're beginning to see that already now. At any level, that's higher interest rates. For our region, we're going to have increased supply, independent of what Palo Alto does. There are people building homes all around. I would be worried about the price appreciation that we've seen in the past 10 years continuing. I'd be cautious about the volume of turnover, which is really important, but that's a little beyond my expertise, but I'd really look carefully at that, because that's your whole documentary transfer tax, is turnover of stuff. And if the market, which it's doing nationally, gets soft, then you have people staying in place and not being mobile, and then you have higher interest rates. I would be worried that the rate of increase is going to continue.
So
I wouldn't build that in.
So what do you think the rate of increase is going to be for the next 10 years?
I didn't hear.
What do you think the rate of increase will be over the next 10 years?
By the way, just as a giggle, I would have done 5.5%.
Okay.
Okay.
Your giggles are met with.
I mean, we're entering a period where the rate of return is going to get lower for everybody because the economy is going to slow. And by the way, I didn't say a recession. I said a slowdown, which is a middle scenario that might be much more likely, Eric and Greg and Lydia, than a recession. You might more likely will be dealing with a slowdown in 2020 and 2021 than a recession. The realtors here are talking 3, 4, 5% for now. And they haven't seen the impact of increasing supply. That's just, they're looking at stagnation because the prices are higher and they're looking at higher interest rates. So 6% is a push.
Yeah, I know. I think so. And I mean, it's maybe not a big deal if it's one of our smaller revenue sources, but it's our largest, right? And so to me, it seems like a very optimistic assumption, because we're using a 6% rate, which is what we got in the greatest bull run of our life, at least most of our lives. Actually, no, I think in all of our lives.
Let me think
And
one more thing. The hardest thing for anybody to see, for professionals and council folks, is when something turns. It's been going and going and going and going and going, and we're in this great economy. I would counsel to prepare for it to turn or soften a bit. It's really hard. Now, for your budget, you'll be in better shape when do you come up with it, Eric? February, March, April? You do the budget for next year?
May.
You'll know more then than you will in November about whether there's a slowing. It's not something we have to puzzle out today, but it could well be there. Sorry to interrupt.
okay, well, thank you, appreciate it. So I'd like to make a motion. So I'd like to move forward the staff recommendation that the Finance Committee review, comment, and forward the fiscal year 2020 to 2029 general fund long-range financial forecast base case for City Council approval with the following changes. The first change is I think that the property tax estimate is too high. I think the economist said 5.5. Let's try 5.5 instead of 6%. Although I would have assumed something even lower, maybe like 4%. But let's say it's 5.5%.
Yeah, he meant the discount rate.
Oh,
Instead of 6.2.
okay. So you're actually thinking that the 3, 4, 5% is what you think the increase is going to be. Then let's say maybe the property tax should be. Well, let me ask the realtor at the end of the table. What do you think it's going to be over the next 10 years? We've had a massive bull run. Can it keep going 6% next 10 years?
So you're forgetting that we go from, say, people bought their houses in the 70s, they're being taxed on $100,000 a year, so they're paying nothing. People that bought their house in the 90s are paying substantially more. People that bought their house in 2000s are paying way more than that. So it depends. It's not really the rate of increase in the houses right now that matter. It's the turnover and the huge difference between, you go from 100,000 valuation to a 4 million valuation. That's huge. So I'm not as
Well,
concerned
actually,
about
that's-
that part. It's how quickly do we turn these houses?
It's actually a good point. So does staff know what was the increase in property tax, not for the past 10 years, but the 10 years before that, just leading up to the Great Recession, and up to the Great Recession right after? What happened? How did the property tax change? What was the CAGR for the 10-year CAGR?
Before I get to that, let me address your question, Sharp. Basically, we have in 2017, we have 7,300 residential properties that are less than 600,000. On average, about 6.5% of that turnover, so around 500 of those properties turnover. And it's been consistent in 2015. We had 6.7% turnover, 6.8, 6.3%. And in total, we had about, in 2017, 1,300 properties that turn over. So a little over a third of those properties that are turning over are actually below the 600,000. So you do get a considerable appreciation on that. In terms of your question about, let me just take a quick peek. So if you're looking at like a 20-year CAGR, which includes
not
up
20
to
year.
now.
I'm just saying. I'm assuming. I just wanted to see the assumption of we're peak economy, right? Which maybe we're not. Maybe we're going to go up another, 50% over the next 10 years, right? Maybe, right? Not likely, but maybe. I just wanted to know, assuming that we were a peak, and from the last peak to the Great Recession, right, or after the Great Recession, what was our CAGR for that 10-year period from the last to the end of the last Great Recession? What was the
Well, if you
CAGR?
got a 20-year
Give me a
CAGR,
second.
wouldn't that capture that?
No, but we're at peak though right now.
Yeah,
So
but it doesn't matter, because if you gave us a 20-year CAGR period, it would count this year, plus it would count 10 years before.
It would.
So it would count the recession.
well, I tell you, what is it for?
So 20
prior
is
10 years?
8.2%.
Okay, what was the prior 10 years though?
Let me just recalculate that one moment.
So while Taryn is doing that, thank you, Taryn, for being so flexible. Something to bear in mind is even if, I'm not saying this is going to happen, but even if the housing market stalled tomorrow, and for the next however many years, couple of years, because remember, the 10th year of this forecast is probably not very accurate. So if we just look at the near term of the next 3 years and assume the housing market or the real estate market doesn't change over those 3 years, you're going to see growth in your property tax because of that turnover rate regardless. So even if everything stalled, not a dollar was added to your median home price or your assessed value, because properties are turning, you will see growth in your property tax.
And I agree with you guys on that, right?
So I think that's something, again, the 10th year of this forecast is, I'll be the first to admit, not a great, we don't know what's gonna happen in 10 years, but in the near term, over the course of the next 3 years, 2020, 2021, and 2022, we have room to grow in our assessed valuation from a
So,
property
Greg,
tax perspective.
This is why I suggested that next year, you should look and see, when you do a long-range forecast again, how the last one was and what was wrong with the assumptions. And that way you'll get to see.
Well, I actually agree with you. We should do the deltas on the budget. So that's, I think.
But you'll get to see it over time and get a sense of what's
So
right.
I agree with you on the deltas. I'm totally for that, right? And we can make that part of the motion too. But what was the prior 10-year CAGR?
So the prior 10-year, which is from 98 basically to 2007, it was about 4.5%.
4.5%. Okay. 4.5%.
The 20-year average was 8.
Yes, over 8%.
And we're at 6% right now.
Would it not be prudent to go somewhere in the middle, between 4.5 and 6?
We could do that. I mean, in the past, we were a little more, oh, sorry.
So one thing to keep in mind is that as staff is looking at forecasts for revenues, we aren't looking at them in isolation. So we are looking at all of the different revenues, and we're looking at all the different revenues and looking at the risks associated with each of them and making assumptions based on that. And so when staff is bringing forward a long-range forecast, to toy with just a single revenue variable is really probably not the best strategy, because what staff does is we look at things like, okay, we have really healthy property tax growth, so maybe we can be a little bit more aggressive in our property tax estimates, but sales tax, because we're not quite sure where things are at, we've had some stalls, we've had some growth, there are peaks and valleys, on that revenue estimate we'll go a little bit more conservative. So staff is not looking at just each individual revenue and saying, okay, this is the perfect estimate. We're doing that, and then we're also pulling all of them together and saying, okay, is this a reasonable holistic picture? So I caution us to take the property tax one and just drop it without us looking at the risks associated with some of the other estimates that we have in the
So,
forecast.
Greg, you were gonna make a motion. Why don't you make your motion?
Okay. So, my motion is first what I just said earlier, and then change the property
So why
tax.
don't you just say what it is, start from the beginning. What's the motion?
Okay. So staff, the motion is the staff recommendation, which is that the Finance Committee review, comment, and forward the fiscal year 2020 to 2029 general fund long-range financial forecast base case for City Council approval. I agree with the chair, we should have the deltas for the budget, so include that. And then two additional ones. So the first one is, I think it's not prudent to have a 6% increase for property tax, given that we're off of one of the greatest bull markets in our lifetime. Maybe 4.5% is too low, so maybe something in between, so that's 5.25%. So use a 5.25% increase for the CAGR instead. And then the other one is the UAL. I think we should include it. Let's try to really right the ship here. And from what the city manager is saying, it sounds like we could do it. And so I think we should. I think the city will be more fiscally sound because of that. And if it turns out we are pessimistic on this, we'll have some extra money in the bank. So that's my motion.
So when you mean, what's your motion to, exactly on the UAL?
UAL, okay, so basically, on slide, what is slide number is this? This one. Whichever slide number it is. Slide 7. So right now, they have the unfunded pension, what's excluded, not excluded from long-range financial forecast, is the unfunded actuarial liability for pension and retiree health care trust, to include that in there.
Does Greg have a second? Wait.
Just as a
just
minor-
ask if he has a second. I see no second to your motion. I'll make another motion then. I'll move that we, where is this?
Just as a quick,
Wait. Not, you don't have the floor? Sorry. I'll just move that we, accept the long-range financial forecast and forward to the city council for city council approval. Okay. I'll just speak to my motion on that. I do think that it's important when staff looks at this, that they do their analysis, which I think they've clearly done. They've clearly explained how they did it. And I think changing stuff on an ad hoc basis is really a bad policy. I think that if we were unhappy with it, and I'm not, I think the appropriate thing would be to say, you've heard our comments, go back and come forward to us again with a new long-range financial forecast. I'm not in that position right now. I think I'm fine. I think you guys have done your analysis. I think, all these numbers on a long-range financial forecast are going to, put it this way, I believe that this long-range financial forecast will be wrong. And I think everyone sitting over there on staff believes it'll be wrong as well. But any financial forecast we will do will be wrong, because if you could do the financial forecast right, you wouldn't be working for the city. You'd be rich. Let's face it. But I do think it would be a useful task, and I think it would help, some of the concerns that Greg has set forth, if when you come back next year, you sort of explain, no, actually, the property tax values were at 6, or they were at 7, or they were at 8, or they were whatever they were at. I do think that would be a useful exercise. But I actually want to say, I think you guys have done a really good job on this. And, I appreciate the effort. I know it takes a lot of time and a lot of effort. And it's, it's an art a little bit, more than a science. And I think I recognize that. So I wanted to thank you guys for your work. Yeah.
So, I concur with all that. I thought the acting CFO's explanation was compelling. Although it occurs to me one way to look at this is, rather than picking a different growth rate in property tax revenues, an exercise that might be worth considering, and I don't mean right now, right this year, but maybe as we go forward, is sort of look at which things are most sensitive and do some sensitivity analysis. Say, okay, well, what happens if this is really that much instead of this? And not necessarily for every valuable, but maybe some of the key ones. That's probably worth considering, right? With respect to the UAL amortization, right? So I agree to a point with Councilmember Tanaka that the more we do now reduces the pain we're going to feel later. Okay. On the other hand, 2 points, and maybe this is overly pedantic, but again, once you cover the normal cost, the future value of the liability, which is the one that we're going to have to pay, okay, doesn't change once you cover the normal cost. So it doesn't get any worse, okay, which is a little bit confusing, but as the city manager pointed out earlier, right, we're going to watch the UAL value increase and increase and increase, but at some level that's an accounting thing, because the value of the UAL is an accounting artifact for what you assume for the discount rate. Okay, you change the discount rate, the current value of the UAL appears, but that doesn't change the amount you're going to have to pay. Right? What's important is what you're going to have to pay. So the future value doesn't change. So I think of the way that we should approach the UAL payment, right? Assuming that it's not dependent on CalPERS, And the reason it isn't dependent on CalPERS is we save more than CalPERS, because we're more conservative than CalPERS, right? The right way to do that is that once we get through the normal cost process, we need to go back and come up with a realistic amortization schedule for the unfunded, for the existing UAL. The problem with going after the CalPERS calculated UAL is this is going to change all that. There's a moving target, right? Because their numbers aren't right, okay? So once we have the right numbers, then a more disciplined approach would be to come up and decide, are we going to pay it off over 20 years, over 30 years, over 100 years, right, and so forth, right? So in my opinion, that's the right way to approach the UAL problem, okay? Does that mean it's not a good thing to pay down some more now? No, it's a good thing to pay down some more now, right? But I have a hard time figuring out how much, right? So I kind of think that we should get through the normal cost process. And actually, I think the next step after what we've done on normal cost here is not to go after the UAL and the general fund, but extend what we've done to enterprise funds, right, and so forth. And also take a look at OPEB, right, so that we make sure that we're actually paying. Because you guys have done great work, but so far we're only tackling the general fund, okay? We need to do the normal cost problem for the whole city, okay? Both OPEB and pensions, both general fund and enterprise funds, before we truly solve the normal cost problem.
Utilities?
I was gonna just say, one clarification is
Yeah.
council direction is that our financial planning
Right.
is at the 6.2 normal cost. It wasn't general fund only, it just happens that before you is the long-range
We're looking at,
forecast.
okay.
Correct, so
But we are
long
doing
range
the
is general
utilities
fund.
in the enterprise funds at the same 6.2% rate.
Correct, so we're assuming
that's good.
across all positions at
Thank
that
you.
6.2%.
Thank you.
Correct,
That was lost on me, okay?
correct. Apologize, long range is just a general fund
Right.
forecast, so yes.
In that case, I think we should be looking at OPEB as well.
So, but let me clarify that, because that's actually a really good point. So, we're taking this $4 million and putting it in the trust, right, and that's for the general fund. We probably should be looking at the utilities, and do we need a separate 115 for utilities?
We already have one, and that's why that long range, or that 115 trust number that we quoted earlier of 11 point some odd million it's all funds, that's not just general fund. And so what we have been doing for my own sanity is we keep the contributions matching. So anytime we do a general fund lump sum, say it's 5% of annual pension costs, we'll go back, later on and have that same 5% contributions from all other funds.
That seems
So
sensible.
we have been, from that kind of practice standpoint, been doing that.
But aren't we gonna get to where it's not a percentage, isn't it just like we pay that normal cost, right? That's what we're doing in the general fund. And shouldn't we just pay the normal cost in the enterprise funds and the utility funds?
Right,
And then the utility rates would have to reflect,
right.
which seems the right way to do it. I mean, people, you
right.
shouldn't have to put on to future generations your utility bills.
Understood.
That's sort of how I feel about it.
And just, when I say percentage, it's a, normal cost is a percentage.
Okay.
A UAL will be a flat dollar value, like a home mortgage, but normal cost is gonna be a percentage-based, calculation.
So we are doing that.
Mhm.
So it'll actually be more than 4 million we put into the trust.
At this moment, what the council is taking action, or what the committee, took action on earlier in item 1 is general fund only. But typically, like I said, what staff will do is come through probably a mid-year report or the next year's budget cycle and get the remaining funds to contribute the same ratio of
And
funding.
then on an ongoing basis.
Correct. So when we
So
do
it's
our,
when you say ratio that I get confused, because it's not, is it really a ratio? Isn't it more, I just thought there was a number that the utility has that's the difference between the 6.2 and the 7, whatever it is.
And so I'll jump in there a little bit.
Correct.
So starting in FY 2020, that's what's modeled. That's what's in the forecast for the general fund, and that's what's being used to develop the budget across the organization. What we're talking about now is the $4 million in FY 19 that we're doing on a one-time basis, and looking at that as a percent of the overall pension contributions for a given year, and applying a like ratio elsewhere.
All right, but eventually we'll get to just making sure we do it correctly. All right, hold it. Councilmember Crew, anything? No? Councilmember Tanaka?
So, you suggest we have deltas to the budget. I think that actually makes sense, right? Because that helps guide, like where we were right, where we were wrong, right?
I was talking about long-range forecasts.
How's that?
What I was talking about was looking at
Oh,
the
yeah, sorry.
long-range forecast.
Deltas to long-range forecast, right? So we see,
Yeah.
yeah, and I think that makes sense. So, I'd like to make amendment to have that as part of the motion.
Okay.
Okay.
Yep, I accept that. All right, anything else? Okay, on,
I'll just say, I think I hope, I hope for the city's sake, we are at 6% for 10 years. That'd be awesome. I mean, I'll be the first to celebrate. I just think it's incredibly optimistic, but I hope I'm wrong. I hope I'm wrong on this one.
Well, there's no way we will be at 6% for the next 10 years, I can assure you. Because something's going to change along the way that will have us adjust even what that new forecast will be, right? I mean, we're not going to lock ourselves into things. We're going to watch the trends and adapt as time goes on.
Cross your fingers for the Palantir IPO.
Palantir IPO. All right, all in favor? No? That passes 3-1. All right. With that, do we have anything else, or is the meeting adjourned?
So our next meeting is next Tuesday. So we will see you in.
Anybody want to do it Wednesday? Oh, yeah. You know, we didn't talk about that. Can anyone do it Wednesday? Can you do it Wednesday, staff? Let's look. 'Cause
We have our outside auditors coming. I'm sorry. We would need to. Even better. So.
you sure you don't want to push harder? I'm willing to push harder.
Can you do it at a different time of day?
Mhm.
Can you do it in the daytime?
Yeah, we could do it earlier. Are you calling in for this? Okay, and does it matters to you when you call in?
Well,
I mean, I don't know what the time is.
It's 3 o'clock in the morning.
It was weird, I was wondering that, I don't know.
It could be really hard.
So that would make
Middle of the night, perfect time to call in.
I mean, you'll be awake, right?
All right. Well, I was trying to figure out the Japan time, so I was trying to figure, I don't know what the difference is.
ahead.
8 hours.
Yeah, 18 hours back, or 8 hours back.
So if we do it earlier, normally you basically, what you're planning to do is waking up in the morning and getting on, that's what your plan is, right?
Yeah. So what time are you proposing?
Well, since you're driving this,
I'm happy. 3 o'clock in the afternoon.
Does that work for you all?
well, I don't know, let's find out from Greg what,
3 o'clock on December 5th?
But you got energy.
I want it early.
Tuesday the 4th. The reason why I say the auditors are coming is because they also have other night meetings sometimes
you know
for
what?
other organizations. So I think an afternoon would.
just out of luck.
I was gonna say
I think I'm out of luck.
I think you're just
it's
out of luck.
easier to move it up. I think a daytime meeting with a daytime meeting for the auditors is easier. I think they're just traveling. They probably have maybe daytime work meetings. The reason why I say a Wednesday is harder is because they may be at another public meeting.
So
But I
why
think
do
if you
have a
want to do an
special city
afternoon.
council meeting on, do we still have that? 5 o'clock? I have that on my calendar. Do we still have that?
It's the CAO.
So if that's what you're into, so I guess we could still do 3 o'clock. I mean, we could do 3 o'clock if 3 o'clock is something people want to do. And it's really, can you do 3 o'clock or not?
What day?
On the Tuesday, the 4th.
The problem is I have a meeting at 4, unless it's a really short meeting. And I have to get to that meeting, so I'll have a half hour, because I have to get on the train.
Oh, that's right.
Isn't everything you can make a recommendation goes to city council? For the most part,
Yes.
get notified at it, and then do the recommendation to the city council.
Yes.
So you can't do it, is what you're saying, because you have a meeting at 6 a.m. or whatever. I don't know what time it is over there.
4 o'clock. 4 o'clock is, 4 o'clock is, but it's not 6 o'clock, I know that.
6:15.
It's not.
Okay, they're just bringing it to closure. Oh, Greg's still looking at his calendar.
No, I mean, we could also do it Wednesday, but what time Wednesday?
Not Wednesday, Tuesday. really think it's Tuesday at 3 or we don't, or we just keep the same time. Well, I can do 2.
What time is 2 in the morning?
2 p.m. in California would be 7 a.m. in Japan.
Okay, so 2 p.m.
That's early enough.
Okay.
Clerk's office, does that work for you?
Okay, so 2 p.m. I'll move that we move the Finance Committee meeting to 2 p.m. And if you could notice it for that. Again,
Noted.
Second. All in favor? And that passes unanimously.
2 p.m. on December 4th.
Yes, on December 4th. All right, with that, the meeting's adjourned.
Thank you.
Thanks, folks.
Thank you.
Nicely done, folks.
In the